Welcome to this explainer. So today, we're totally flipping the script on personal finance. We constantly hear these endless debates about what to invest in, right? Which stock to pick, which index fund to buy, when to perfectly time the market. But what if the actual sequence of your investments matters infinitely more than the investments themselves? Well, we are diving into a definitive step-by-step 2026 map that proves exactly when and where you put your money is hands down your greatest advantage. Let's get right into it.
Let's start with a little tale of two investors. Picture Alex. He's super excited. He day trades the latest trending stocks on his phone, and he really feels like he's taking charge of his wealth. But he's also carrying a pretty hefty credit card balance. Then we have his coworker, Grace. She doesn't chase any trends. She just routes her dollars in a very specific, totally automated sequence of accounts. Now, fast forward 5 years. They make the exact same income, they save the exact same amount, and honestly, they invest in the exact same boring index funds. Yet, Grace ends up $40,000 ahead of Alex. No way, right? But it's true. She didn't pick better stocks. She literally just put her dollars in the right order. To understand exactly how Grace pulled this off, you kind of have to think of your money like water falling down a series of priority buckets. It's like a giant waterfall. You only ever fill the next bucket when the highest return bucket above it completely overflows. And this entire flow is governed by 3 golden rules. First, a guaranteed return always beats a maybe return. Second, tax-free money beats taxed money every time. And third, money you can actually access beats money that's locked away. Burn these 3 rules into your mind because they absolutely dictate everything that follows in our 2026 map.
Okay, phase 1 is defense, securing your base. Before we get to the glamorous stuff, we have to stop any financial bleeding. Here is that defensive sequence. Step 0 is just a tiny $1,000 to $2,000 cash buffer. This is just to prevent immediate disasters from landing on a credit card. Once that's secure, step 1 is capturing your employer's 401k match. That is literally an instantaneous 100% return before the stock market even opens for the day. Step 2 is going to absolute war with high-interest debt. And finally, step 3 is building a fortress of 3 to 6 months of living expenses, ideally parked right in a 2026 high-yield savings account earning around 4%. Actually, we really need to completely reframe how we view step 2. I hear people constantly asking, hey, should I pay off my credit card or should I invest? Well, just look at the math. Paying off a typical 21% credit card balance isn't missing out on the stock market. It's locking in a guaranteed, risk-free, and tax-free 21% return. Seriously, a Wall Street hedge fund manager would kill for those kinds of numbers.
Now, when you are attacking that debt, you've basically got a choice to make. You can use the avalanche method, where you aggressively attack the highest interest rate first. Mathematically, this is definitely superior. It saves you the absolute most money. But let's be real, humans aren't spreadsheets. If you've tried to pay off debt before and just ended up quitting, you probably need the snowball method. This is where you pay off the smallest balance first just to get that quick, awesome psychological win. At the end of the day, the very best debt strategy is just the one you actually stick with until the debt is totally gone. All right, moving right along to phase 2, offense, wealth building. The base is secure, so it's time to grow your money and really leverage those 2026 tax codes. Step 4 introduces an account that so many people just completely misunderstand, the Health Savings Account, or HSA. Most folks think this is just some boring checking account for buying Band-Aids, but no, it is secretly the absolute best investment vehicle in the entire tax code. Why? Because it gives you a triple tax advantage first. Your money is tax deductible going in. Second, it grows completely tax-free. And third, it comes out completely tax-free when you use it for medical expenses. Literally, no other account lets you bypass taxes at all 3 stages. A huge pro tip for 2026, savvy investors pay their current medical bills out of pocket and just let their HSA dollars invest and compound tax-free for decades. Moving down the waterfall to step 5, we hit the beloved Roth IRA, boasting a fresh $7,500 contribution limit for 2026. You know that eternal Roth versus traditional debate? It really just boils down to one simple question. Do you want to pay taxes when you're poor or when you're richer? If your tax rate today is lower than you expect it to be in retirement, go Roth. Just pay the cheap taxes right now. But if you're a high earner right now in your peak earning years, well then the traditional IRA's upfront tax deduction starts looking mighty attractive. So, mapping out our complete offensive sequence, first, we max out the triple tax magic of the HSA. Then we max out the Roth IRA to lock in that sweet tax-free growth. Once those buckets are completely overflowing, the water loops back up to step 6, which is topping off your employer 401k all the way up to its 2026 limit of $24,500. And hey, if you are incredibly fortunate and still have money flowing after all that, step 7 is utilizing the mega backdoor Roth. It sounds like a cheat code, and honestly, it kind of is. It allows high earners to shovel tens of thousands of extra after-tax dollars into a tax-free Roth space, assuming your employer plan allows it.
Wait, I actually need to pause right here for a really quick but super urgent 2026 caveat for our older listeners. Thanks to the new Secure 2.0 legislation, if you are between the ages of 60 and 63 this year, you get a massive super catch-up allowance of $11,250 for your 401k, and that is on top of the base limit. If you're in this narrow age window and maybe feeling a bit behind on retirement savings, this is an absolute gift to rapidly fill your buckets.
All right, phase 3, the ultimate freedom bucket, total liquidity.
Step 8 is just your plain old taxable brokerage account. Yes, it's the least tax-efficient bucket in the whole sequence. But it has one massive superpower: total liquidity. As the old saying goes, the retirement accounts buy your old age, but the taxable account buys your freedom. If you want to retire early at 45 or take a midlife sabbatical, this is the supreme engine that actually funds it, because you don't have to wait until you are 60 to touch a single dime of it. Okay, phase 4, avoiding common leaks. We have to plug the drains where your wealth is quietly escaping.
Let's look at the 4 biggest leaks. Number 1, investing while holding a 21% credit card balance. Remember Alex from earlier? He was losing way more to interest than he was ever making in the market. Number 2, leaving your employer match on the table just out of fear of the stock market. That is literally turning down a free raise at work. Number 3, endlessly hoarding cash. Look, a safety net is absolutely vital, but parking 2 years of living expenses in cash while the market runs away without you, that's a massive leak. And finally, number 4, chasing excitement, skipping those boring tax-advantaged accounts just to trade flashy stocks. You've got to make peace with boring, because trust me, boring is where the real money is made.
All right, let's look at the final scorecard and see exactly how that $40,000 difference actually happened. Both Grace and Alex had the exact same $1,500 a month to invest. Grace captures her 100% employer match, she carries zero debt, she fully funds her HSA and Roth, and then tops off her 401k. Every single dollar she has lands in a bucket with either a government match or a massive tax break. Meanwhile, Alex, he dumps all his money straight into a totally taxable account while bleeding 21% to his credit card company. It's the exact same money, but a wildly different sequence.
So what does this all mean for us? You could spend years of your life arguing on the internet over which stock to pick or whether today is a good day to buy, but the sequence, the exact order of this waterfall is the real edge that you completely control. So take a really hard look at your own accounts today, consult the map we just went through, and ask yourself exactly which bucket is your very next dollar going to land in.